What's up, guys? Welcome back to Everyday Money. This Wallstreetbets short squeeze meme stock thing that's been going on has been super exciting. I mean, I've really enjoyed watching it. I've enjoyed watching a group of folks on the internet stick it to the big guys. I like that people are upending the system and there's chaos in the system because I'll be honest with you, in a little bit of a way, I sort of just like to watch the world burn. So that kind of chaos and just upending has been extremely exciting. People are getting rich using the same tactics as the big guys. There are some folks on Wallstreetbets that have turned tens or hundreds of thousands into tens of millions of dollars, and the feeling of community and such has just been really awesome. Unfortunately, it looks like that is running out of steam, at least in GameStop and AMC. And we'll see if it happens again in another stock that's incredibly shorted. We'll see if these hedge funds adjust their shorting strategy so that they're not shorting so much of the float that it's easy to squeeze them. That's yet to be seen as time goes on. But I wanted to talk about what this really is. This short squeeze thing really isn't investing. Maybe for some of the folks that got in really early, like Deep Effing Value. I read some of his stuff, and he had been in since like September or so when shares were really low. And he said, yeah, they are making some changes to this company. And then it looked like he had a plan for that stock to go up in value over time. And then when it started being shorted and then it started being squeezed really hard, he was able to cash in on a windfall and make tens of millions of dollars. So you may say that that was an investment on his part, but a lot of folks just in the retail market, they weren't investing. They were getting in and trying to make a quick dollar, and usually we call this gambling. And that's exactly what it is for most of the people that got in on GameStop, got in on AMC. It was either gambling or it was a movement. A lot of people wanted to stick it to the man. They had lived through 2008 and the housing crisis, the investment crisis that went on with that, and people were a little bitter towards those big money folks, and they had this movement where they wanted to squeeze them, and they did in a big way. They squeezed tens of billions of dollars out of the hedge fund investors. It was fun because there's nothing really wrong with gambling if you can have it under control. It's fun. Going to the casino is fun. I've done it. I participated in this short squeeze action. It was a ton of fun. It creates a huge amount of excitement, but it's also a house of cards, and houses of cards can fall at any time. And if the excitement stops, then the game stops. And the difference between the excitement and the game and the gambling and investing is, to be honest with you, I have found investing to be fairly boring. You're looking at a long-term play or plan, like for example, index funds or real estate, things that you can put into place, and that, like for example, index funds, you can see that they've had a track record for hundreds of years. If you're tracking one of the major indices, you're going to get your 10%. And it's going to be boring but predictable returns. You're going to put money into it. It's going to grow. There's going to be slow growth at first and exponential growth towards the end of whatever your time frame is. In real estate, there's lots of downtime where you're waiting for things to sell. You're waiting to look for something to buy. It costs a ton of money to get into, but over time the rewards add up. You start selling less expensive properties, you buy more expensive properties, and again, there's sort of that exponential return on your investment over time. And maybe even in individual stocks, if you're looking at blue chip stocks that have a consistent dividend history, they look like they're going to go up in value, or they just have consistently gone up in value, and you can predict some sort of return or some sort of performance for your investing dollar. That is what I look at as investing, instead of going out and trying to make a quick buck either on gambling like this or even trading. There's a reason they call it trading instead of investing, because you're trying to trade stocks up and down for a quick dollar. And that goes in a lot with gambling, in my opinion. You see, the thing is that the people on these trades that made the money, that are more of the investor than the gambler, they're way over here. They're over here when it's low early on. They have put in the work and see that there is a potential for this to skyrocket or at least go up, in some amount of value. And then when they make their money is right here. When the event happens, these guys are in the money, and they're going to be the ones that turn their $10 or $100,000 into several million bucks. And then it's going to get really popular. The word's going to get out, and then these folks over here are going to get in. These are the gamblers, and they might double their money on volatility. It might swing wildly, or they might half their money or lose almost all of it, and then we just end up being the folks over here on this end where the game is over, and we're the ones left holding the bag, so to speak. As you can see right here is the value of the like button before it is smashed, and then over time, as more people smash the like button, it becomes right here, and we have the infinite growth in like button smashing to help this video and this channel out in the YouTube algorithm. Now, this reminds me of something I heard from way back in the pre-depression era. If you've ever heard of Joe Kennedy, patriarch of the Kennedy family, in 1929, it was rumored that he was getting his shoes shined, and the shoe shine boy was giving him stock tips while he was getting his shoes shined. He said, "Listen, man, I got this hot tip on this stock." And he was sitting there thinking, like, man, if the shoe shine boy, who really has very little financial knowledge, I'm sure at the time in 1929 there was a lot less information available to the general public. How is this guy giving me advice? And it feels like that right now. Everywhere I go, some people are talking about stock tickers. They're talking about the next crypto coin to buy. And it seems like there's a new crypto coin that I'm hearing about every 5 minutes. What options people are going to be putting on things. People that have never talked about options before. And I'm not saying that it's going to crash right now as far as the stock market or the real estate market, because I just do not think that the government will ever allow a 1929-esque crash in the stock market or a 2008-esque crash in the real estate market. I think we've gotten to the point where the government, depending on if it's held by Republicans or Democrats, is more willing to throw a ton of debt at the economy than they are seeing folks lose everything that they have. Regardless of what your opinion is on that, I think that that's just the way it is. But right now it feels a lot like Joe Kennedy's 1929 moment when everyone just has the next hot stock tip. So what are you going to do out there on the other side of the camera? What is it that you should do? There are internet people telling you that you need to buy. There are people on TV literally saying buy on the CNBC channel. There's people saying that we're going to take this to the moon with stocks or this next coin. Internet people like me that are saying, no, you need to invest. You just need to stay the course. You need to put together a plan, put together a long-term plan that doesn't matter if things go up or down or sideways or whatever. If you're on the other side of this camera and you're looking at this internet guy, what I'm going to tell you is that you just need to do the same things as you would during a crash. You need to stay the course. Right now, the thing is, everyone's having this fear of missing out, that they're missing out on this giant trade, and they're thinking about their millions of dollars that they could have made off of their $10,000 investment, $10,000 gamble, and they're thinking about their yachts that they're going to buy and their, vacation homes in Vail that they could buy, and they're getting this fear of missing out syndrome, which is almost the same as when stocks are crashing and people are feeling like they're losing all their money and they feel like they're missing out on selling their stocks at the highs or selling their real estate at the highs or whatever it is. But just like a crash, you need to stay the course with your core investments. So if you are a real estate investment guy, you keep the course on that. You buy your multifamilies or your single families when they are right for them to buy. Rent them, sell them when it is the right time to sell, and either move into a different asset or move up, in properties or whatever you want to do with that. If you're an index fund or stock investor, you just keep plowing your money into those according to your investment strategy. If you're a dollar cost averager or whatever, over the course of time, each index is going to get like 10% annual returns, values, and dividends, and there'll be years that it's up 20%, such as this year. There'll be years that it's down 20 to 50%, like as in 2008 and 9. These things happen, and over the course of time, everything will even out. If you want to play, if you want to gamble, do it. But do it with money that you can 100% lose. I bought 16 shares of AMC, and I knew for a fact I was gambling. This is no different than if I would have put it was like $230 or whatever down on black at the roulette table. Absolutely no difference in my mind. Other than I was able to put a stop loss order in. I said at $10, I think I bought it at $14.50 a share. I didn't want to go any lower than $10 because I'm not that brave of a gambler. And I put that in so at least you can't lose all of it. It went down to like as soon as I bought it at $14.50, it just went straight down. And this morning the trade executed at a market trade of $10, but it ended up executing at $9.75. No big deal. I had fun with it. I had fun yesterday watching the stock, just like I would have fun at the roulette table, at a blackjack table, at a craps table, sitting there having some drinks and having fun, but knowing and pretty much expecting that I'm going to lose it all, because it's not an investment, it is a gamble. Don't focus on the shiny object. Don't focus on the shiny object and get that shiny object syndrome. Stick with what you know. If you want to transition into something else, do the research. Put in the work in the future, or else you are just gambling with your money. So I love sticking it to the man. Anytime that we can push back against the giant hedge funds and kind of beat them at their own game, it's a fun time. Now, they're not going to be bankrupt. They're still going to be billionaires at the end of this. Even if their funds go under, the hedge fund managers are still going to be extremely rich, and they'll start a new hedge fund. So it's going to be a game that goes on, for all of time probably. But guys, if you like this video, smash that like button for me for the YouTube algorithm. If you haven't subscribed yet, be sure to subscribe to grow your wealth, increase your success, put you on the road to financial freedom. I appreciate you guys watching today, and I will see you on the next one.